And we're back. Not much has changed, and Kashop and I were just kind of talking about this. That not much has changed in what we're doing right now. Our portfolios are very similar. We're kind of looking at gold miners leading the way. We haven't. I don't think Kashop's changed many positions. I haven't changed many positions. Only thing I've been adding to international, adding to gold miners as the time has moved on. I'm sure if I asked Kashop, he would say the same thing. He can answer that in a sec. Um, I just want to start out with a couple slides. Just to talk about what we continue to see. And yeah, I could have added gold miners in here, and they'd be up over 20%, and make us look a little bit cooler. But 15% in gold, and it's not even 3 months, 3 full months into the year yet, is a pretty large return. And so you kind of got to look at this and go, okay, what is lagging? What is leading? And this is why every single week I go through this on Mondays, which is leaders and laggards, which is trying to figure out what is leading the way, what is not leading the way, what could continue to lead the way. And a lot of the time that you see these leading sectors at the beginning of the year, it usually ends up that way. And now that we're 3 months in the year, I think we're getting kind of a better picture of things. And that picture is saying gold has led all year long. Energy led at the beginning of this year in January for a minute, and then it came back down to earth for a minute, and now it's leading once again, up 8% year to date. Healthcare behind that, which is a defensive sector. Utilities behind that, which is another defensive sector. But financials are up there as well. And with energy going from all the way to the bottom to the top, it makes me wonder if we'll see things like materials start to catch up to the energy sector, and really just kind of see tech kind of take a back seat like it has. Technology is down almost 10%. I mean, depends on if you're looking at all these sectors as a whole. If you look at XLC, XLK, XLY, I'd say about 10% down as a whole. Those are all technology sectors, in my opinion. And then if you go up the list, you see industrials is actually down year to date. Consumer staples are actually flat. Everybody's talking about that consumer staple outperformance and how it would continue to go forward, and it just didn't seem like it did. And then it just kind of came down to earth once again. Real estate up 2%. It just looks like a very inflationary year, where people are going to go back and forth and try to get some defensive exposure and whatnot. So, Kashop, going back to you, how are you positioned this year?
So I'm primarily long. So let me just break it down in terms of exposure. So the biggest one is gold exploration stocks. So that's the pre-revenue gold companies because I think they have the highest alpha to the gold price. And the next biggest is the gold miners themselves, followed by LNG, then copper, then a bit of oil, and then you go to the other sectors. So I have a small allocation to luxury. I have a little allocation to casinos and gaming. So those are all the smaller exposures, but the primary one, it's all tied to the inflation trade. And the simple reason for that is this is exactly the environment in which that will work. So go back to a year ago. So just go back to March 2023, March 2024. What was the vibe then? What was the buzz? Everywhere you went, it was all about AI, it was all about Bitcoin and crypto more broadly. And that was the narrative. And that was the only thing investors were focused on. And if you looked at liquidity flows, what was happening was investors were just selling everything else and moving into these sectors. And even if you talk to any growth investors or even value investors, active fund managers in that time, what they told you was, yes, I know this is cheap, but I have to sell it because I have to buy Nvidia. And it doesn't matter what the fundamentals are, as long as this company is not going to have a great next quarter or the next couple of quarters, I can't hold on to this stock. Because when the narrative is such that you have to chase the max 7, you have to chase US equities, and you're sitting there and saying, I know Vietnam is going to do great in the long run, but I just can't buy it right now. And that's pretty much what everyone was saying. And everyone knew that the Max 7 trade would end and then they would go back into their favorite stocks. But it just took until maybe sometime around when Trump came into office for people to say, yes, it is now consensus. We are done with Max 7. We can go back into our favorite trades. So just like you had investors en masse selling all their favorite trades to chase the Max 7 last year, now they are all en masse selling the Max 7 to go back into their favorite stocks from last year. So that's why this rotation is so rapid, because everyone knows what they want to buy. They have been waiting to buy and they are buying. And everyone knows what they want to sell, and they had been waiting for it to become acceptable to sell those stocks, and now they are selling. So if you look at, I was just reading on Twitter today that CTAs have sold short something like 30 billion worth of US equities and bought 42 billion worth of European equities. 1 year back, the trade was to short Europe and go long US. Now it's the reverse. And if you look at the euro has gone straight up. Now I know the move in percentage terms is not that big, but if you just look at the chart, it looks so cool. I never seen a flag pattern on a currency like that, except when some peg breaks. So
Yes.
yeah,
No, it's interesting because the euro is moving more than everything else. It's the one out of all the currency trades. I really don't trade the dollar futures, and I really don't trade the euro futures much, just because they're just so inverse of each other. It's really there's really no point, in my opinion, most of the time. Once in a while, though, the move is all in the dollar and all in the euro, and we're just seeing the euro. It had this huge, massive move. I think it's outperforming the rest of the currencies right now, which is really interesting. I haven't seen that in many, many years. So the euro is making a big move against the dollar. The dollar's coming down quite a bit. I think this looks very inflationary, and I think a lot of people are kind of stuck on this. It's not inflationary. It can't be inflationary. Inflation is dead. You crazy people, and like the market's just screaming like inflation over and over again. And we just see that in so many areas. And one thing I wanted to get to with you on here is kind of talk a little bit more about the international leadership that we're seeing. Like you said, you were talking about Vietnam, and you're right. It's like it doesn't matter. Like I just once again, I understand a lot of people, and even myself. If I was to go into Poland, for example, and try to figure out what exact stocks I want to buy, that might be tough. It's a good time for the ETFs, especially if you can look inside of these holdings and make sure it's not so heavily weighted to one thing or another. Argentina is very heavily weighted to one stock. So sometimes you'll see these things very heavily weighted to one stock. You kind of want to avoid that, or just buy that one stock if that's the case, and you want to be invested. But I do like the ETFs for these type of trades, because you can kind of get into them, get out of them pretty easy. They're liquid enough. A lot of people were having this conversation with me the other day about liquidity in these ETFs. And I was just like, are you running a $1 trillion fund I don't know about? like what exactly, how liquid do you need these things to be? Because I trade them. I've been trading them for many years. I've never had any issues. And really it's there's a bunch of things. Stock pickers can look at these ETFs, go inside of the countries and really find, things they want to buy. And people like me who would rather buy either the country index and futures or the ETFs as a whole, we can just buy those and kind of ride those trends. But I think any way you look at it, you have to start looking outside of the United States. You know, people always talk about home country bias, and it's funny. I brought this up on a show the other day, and the return back to me was kind of like demeaning in a way, because I said, it's not. Yes, I know the historical home country bias is United States citizens love to invest in the United States. But what I said was, it's global. I said everybody invests in the United States now, because for the last 15 years, it's been where the performance has been. There's been no reason to invest anywhere else. Actually, 17 years now. So, you continue to buy in these other areas, and you've just lost money and you've underperformed. And so everybody's just really piled into United States stocks at this moment, all over the world. And you're outside of the United States, so you tell me, does that make sense? Because for me, even when I talk to people who are outside of the United States, they kind of say the same thing.
Oh, absolutely. Like everyone says they do global equities, but when you break down what they mean by global equities, they mean Apple, Tesla, Google, pretty much any of the Max 7 names, maybe Taiwan Semiconductor, and maybe, just maybe, something on the Hong Kong exchange. And that's it.
Japan, that's the other thing.
Yeah, Japan.
People are
Yeah.
like, oh yeah, yeah, Warren Buffett's a global investor. He invests in Japan a lot. It's like that's basically the United States at this point.
Yeah.
I'm sure they don't want to hear that, but it's the truth. It really trades in sync with the United States.
Yeah.
Not saying it's a bad thing to buy at certain times. Not saying I hate the idea of buying anything in Japan. Just saying it trades very similar to the United States, and I see the outperformance in all these different areas that nobody's looking at. I mean, Germany is up 20%. I mean, it's Italy's up, Chile, Greece, China, Spain. It's just endless, and you keep seeing this over and over again, which is okay. It's all of these countries in South America, it's all of these countries in Europe, it's countries in Southeast Asia, and you keep seeing the same kind of theme over and over again, and everybody just kind of goes, yeah, when's the Mag 7 gonna start leading again?
I don't know, like it's like generals fighting the last war. Everyone wants to go back into the trade that was cool, in the previous cycle. And they just don't get that the market has changed. And why has the market changed? Because for a very long time, it was max 7 or else. And now comes the or else part. So when the or else takes off, why would the max 7 perform? It's like last year, if you're looking at, let's just pick a random sector, offshore drillers, and you're saying, my offshore drillers should do great because look at the fundamentals. And that was true. But what was happening was investors were pulling capital out of funds that invested in offshore drillers and allocating capital to funds that promised the next big thing in AI. So when you have this relentless flow dynamic, even if your offshore drilling companies as such are doing well, the stocks are not going to, just because of the selling pressure. And it's that liquidity drives everything. And now that liquidity has started to flow the other way, why will it reverse? Because some of these trends, they tend to be very long lasting trends, especially the liquidity trends. So you go back to Vanguard and all these big funds, right? Like I was just reading a study the other day that the 401k IRA funds, that's something like $1.5 billion a month of passive inflow into US equities. Now, just imagine there is not even a bear market, a 10% correction, which lasts for 10 months. So it's both, the correction is both in terms of price and time. Now, if you have a 10% correction that lasts 10 months, there's $1.5 billion in monthly inflow into US equities is going to get halved or is going to get cut massively. And that's just because people can't take the pain of watching something not do anything. It's like you
Yes.
go sideways for a long time, people can't stand it. And you remember this happened with Bitcoin. So March 2024, Bitcoin peaked something like 71K, 72K something. And then it just went nowhere until November. And everybody got frustrated. It's not that it was in a bad market, it was just not in a bull market. So people got frustrated. And that's just what tends to happen when you have these prolonged sideways moves. So, if the Max 7 don't correct and they just keep going sideways, that's going to rile a lot of people off and that's going to change flows like anything. So do you really want to be in the Max 7 or in US equities in a situation where they just go sideways while you look at gold and it looks like Nvidia in the 2023 cycle? Like just go straight up. In fact, gold is up, I think 50% since the start of 24 or something. It's like a crazy wild performance. And you go back to 2002 when, after the dot-com bust, you go look at the chart of gold. 2002 to 2006, gold went up straight for every single year. So the first year in which gold had a great return was followed by another year and another year and another year. And The trend was only broken by the 2008 crisis, but after that, once again, it went straight up for 3 more years. So you have those crazy long trends, and then you have long sideways movements. So do you really want to be in the long sideways movements on your previous winner, or do you want to get on to the next crazy long trend and keep compounding your gains that way? Now, as a trend follower, I know your answer, and you wrote a great post about it, which I think you should talk a little more about that, because I found that very, very interesting. And I know your style, but the the chart that you posted with the drawdowns and the compounding, that was just amazing. So let's talk a little more about that.
Yeah, so I started writing a series. I don't even know when I started it, probably 2 or 3 weeks ago. And it was kind of, I had somebody reached out about trend following and wanting to know a little bit more about trend following and how to trend follow. And so I thought, hey, I'll go through it historically. I'll put some back tests up. And part 3, I'll just really write about what I do, how I do it. Part 2 just came out yesterday, and the idea behind part 2 is just to kind of give everybody a little bit more actionable things about it. What does a back test look like? And the back tests are basically, they're very good. However, they're not right all the time. They're right about 40% of the time. And how do these make money? And this is something that's significant for everybody who's watching to understand. How do systems make money if they're wrong more than they're right? And this is a very simple answer, and a lot of people know this already, but a lot of people don't, which is the winners are bigger than the losers. That's really the biggest thing about trading for everybody, which is just figure out a way to make your winners bigger than your losers. And especially if you can start to quantify that. What if I do it, in a way that I make $5, and then on my losers I lose $1? That means I only have to be right 20% of the time. And so if you only have to be right 20% of the time, and then you can up your win rate to 40, even 50%, now you're making a killing. And so that to me is everything that you need to know about trend following, which is you can create these systems and strategies, and they have great returns. Over 25 years, the drawdowns are actually less than the S&P 500, but a lot of people would say the drawdowns are huge, they're massive, they're so painful. But I think trading generally is painful. I don't know anybody who's avoided pain or has a win rate above 80% in the long run. I know
The
some.
liars.
Yes,
The liars
the
have it.
liars
Yeah.
do. There's some. I see some person all the time that posts like 90% win rates and stuff, and I'm like, yeah, that's great marketing material, but like, what do your returns really look like? Like, at the end of the year, we'll have, half of our thing will be yellow, meaning closed trades, and maybe half of those, or even more than half of those, will be losers. But at the same time, we'll have these great returns. And so, like, you have to ask yourself the question: is your idea of trading well to be right all the time? Because that doesn't help anything. And this is the thing that we try to teach a lot, and a lot of people buck this, which is the idea that there's a difference between being right and making money. People buck this because they just want me to say, hey, if you buy gold, you'll be rich. You buy these miners that Kashop is researching and knows the most about, you'll be rich. And the real answer is, if you set up your strategy properly, if you're position sized properly, if you have risk management models, then you'll be rich. That's it. That's actually the biggest secret. And then figure out what if you do that first, and then figure out what style of trading you do, that's everything. Part 3, I'm going to make a note of this because I know I'll forget it if I don't write it down. But part 3, I just thought about I should do a thing on Tom Basso's coin flip model. So Basso had a coin flip model, and I've done it too. Any backtester's probably done this, which is when you take position sizing, and if you want to figure out if your system is very viable and it can make money in almost any environment, you do a coin flip model. Meaning, if I'm looking at silver, and I go, okay, coin flip, long or short, and it says short, even though I would look at the trend and say, oh, don't do these things. It doesn't matter for the purpose of this backtest. So I would go short silver here. And then the next one would say gold, and maybe I'd go long gold, and maybe I'd go short oil, and maybe I'd go long equities, whatever it is. You just kind of back and forth, whatever the coin says. And then you test the model. Then you see if it still makes money. Most of the time, you can make these systems, if you have the right positive expectancy, make money. And so then you have the strategy that you need to run. The position sizing, the stop losses, everything is already perfect. And then you add in the next part, which is, okay, then what system am I actually running? And that system could be breakout systems, 100-day highs. It could be Bollinger Band breakouts. There's a million of them that I listed in the thing yesterday. Sorry, I say too many numbers. 4 of them that I listed, or 5, I think, that I listed yesterday, that you can see the compounding, the returns, the max drawdowns, everything. And so, the goal of all of this is to kind of teach people, hey, if you just set up your systems properly and you set up your position sizing properly, you'll make a lot of money. And if you do the opposite, you just bypass all that, and you go, I'm just going to go on Twitter, and this guy who says he's right 90% of the time, I'm just going to follow his trades. He's obviously right all the time. And this is why a lot of people then go, damn, I'm not making money. At the beginning of my service, I had a bunch of people come on and kind of go, this is cool, but there's not enough trades. You're not trading every single day and all of this stuff. And I'm like, well, there's no trader has a trade every single day. And then they'd be like, well, this guy does, and he has a 99% win rate. And so I actually made that guy's system and I reposted it. I didn't tell anybody this at the time, but I actually took his system, his strategy, and I reposted it, and I showed why it blows up. So people go to these people and then they blow up or they lose money, and then they come back later. And then they go, well, shit, I guess, maybe you did have something to say there. So, and I think this is a normal journey. I'm not making fun of anybody. It's how my journey went. I started out trading. I didn't know a ton about it. I knew a ton about economics. I knew a ton from traders and learned from, my uncle or other people or books, but I never took the time to really backtest and do the things that I do today. And when I started doing those, that's when I started making money and understanding, it wasn't exactly the backtest and knowing that the backtest means trend following works, or the backtest means this works. It's the backtest on the position sizing. That's the most significant thing you will ever do as a trader, is just figure out the position sizing. Make sure you're only losing 1% on your losers of your portfolio, or even 2%. Keep your losers small. That doesn't mean your stop loss is very close. That's a whole nother thing that I'll cover in the next part, which is volatility of each product and how you're going to do that. But yeah, it's been a fun project. I'm excited to continue to do part 3. It might turn into a 5-part series. 3 might be it. I don't know, but it's been fun to kind of write. I didn't know if anybody would like it, and then it became our most read thing on the page. So I'm excited.
Yeah, and it was great. So I come at it from the other side. So I'm a discretionary trader, and for me, I learned a lot looking at technicals, looking at how things move. And what I can say is, just like you talk about traders who come into this and they have unrealistic expectations about win rates, when you look at discretionary traders, everyone knows the George Soros story. So everyone knows about this one guy who, just bought Apple with everything, and then now he has a fancy house or whatever. Everyone knows the Stan Druckenmiller story. You have to be a pig, and everyone is like, when you come into this game, you're like, yes, I'm smart. I know everything. I'm going to take this one trade and I'm just going to, make it a 10x, and that's how I am, because I'm so smart. And it happens because if you're a scientist, you have your PhD, you have 10 papers, you have thousands of citations, and everyone in the academic world says, wow, you're so smart. You come into the market with that mindset, and then you're humbled within few days. So there's this famous quote about how was it Newton who said, I can calculate the motion of stars but not the madness of crowds, something like that.
Yeah.
And that's the experience for every discretionary trader who comes into this game thinking he's smart. Now, I've been through this journey. In fact, I've blown up a few times. I wrote about it in the very first article in my newsletter about how I have blown up and how I've learned from that experience. So coming from that, I am always humbled by the markets, and I also know the importance of risk management. Like I can come and tell you, like you want me to talk about one particular stock in my portfolio, I can come and tell you how that's really the best stock. But 1 year from now, I might have a different perception based on how things turn out. And that's really it. No one can predict the future. Even, we look at charts all the time and we draw patterns, but all that tells you is what happened in the past. They don't tell you what happens in the future. Now, it's a probability game. You might say, yes, this means is a high probability setup, and you take 10 of those trades, the probability is in your favor, you win. You take exactly one of those trades and it fails. What does it tell you? It tells you nothing, because there is no signal there. Unless you take 10, 20 trades and you have 60% winners or 55% winners or whatever, and then those winners are great, you really don't have anything if you're just basing it off one or two observations. And people who come in and say, I'm going to put 100% of my capital in this and I'm going to double it within the next year, maybe some of those work because you get lucky, but you
It's not
have that
repeatable.
attitude. Yeah, it's not repeatable. You have that attitude, in 10 years you'll blow up.
Hmm.
And in those 10 years you may have greater returns than Warren Buffett in his 50-year career, but at the end of that 10-year period you blow up and then you go back to zero and then you start all over again, and that's difficult. And
And
that's
people
really
use
the
leverage, and this is the other thing that we need to talk about too, is people are using leverage. If you're using options and so on, like, yes, you can buy the S&P 500 or maybe Apple or something like that and sit in it for the next 20 years and you probably won't blow up. But if we're talking about like real traders who are using leverage, using options and so on, you can blow up very easily. Kashop's talking about 100% into a position. People take 100% of their account and buy call options with it. And that's the times where, like, yeah, like, and when you're doing that with leverage, you don't last 10 years. You'll last 6 months. You'll last a month, maybe, if you're lucky. So sometimes all you need is a little bit of a drawdown or a little bit of choppiness and you're screwed. Like Kashop mentioned earlier about Bitcoin. Let's say you had call options on Bitcoin. Let's say they expired in November of 2025. Let's say you held through that whole flat period. Your call options might be completely worthless, even though you were right. It did make a nice move into November, but you might have had to sell them before they went to zero. They might have went to zero before that. I don't know exactly what date you would be on if you were just in the November monthlies. Maybe you got a little bit of a push, but it wouldn't have got you back to even or to the point where you're making a bunch of money. So you can lose money just from the market going sideways with options. So just a lot of people I think they don't put all of that together and they just go, yeah, that's cool what you guys said. Because even if you're discretionary, you have to still understand position sizing. There's I think systematizing your position sizing is so necessary that big funds pay people just to come in and help them size their positions. I'm working on that right now with a fund. Just helping them size their position sizing for the amount of money they have, and so they can figure out what they allocate to each trader and so on, and figure out the volatility of each trader. For example, you have a futures trader. Let's say he's told to use about 5x leverage. You're going to give him a smaller portfolio than the guy who's just, hey, he's my retirement guy. He has a 60-40 portfolio, let's say. Not advocating for that, but let's just say that's the thing that he does. So he's going to be in 60% stocks, 40% bonds. It's going to be much more lower volatility than the person who's trading futures like I am. So it's a constant, like, let's keep rebalancing, let's keep talking, that's through and working on it, and that's something that, like, you will have to do as a trader from day one till the end of trading, because it's hey, I started out with this amount of money. For me, started out with 5,000 basically, and then you build that up to 10, or then you get to 50. Okay, what do you do now? Position sizing changes, everything has changed. Get to 100K, now it's changed again. Then you get to 500K. Now it's changed. Now I'm adding different contracts that I couldn't trade before. You get to 1 million. Now you're trading different. So it's a constant process of building this portfolio that you have to do as a trader. Like there's no way around position sizing. I wish there was. Trading would be a lot more fun if I could just be like, hey, I know this. Like Kashop said, I have the one. We all have things that we think will work better than another. But if you just take every trade, take the best setups over and over again, and you just let them work out, however they do, winners, losers, whatever it is, you'll make a lot more money than the guy who's like, yeah, that trade will work. I know it'll work. Like, for example, if I was sitting there going, Google's going to come back or Apple's going to come back soon and the Mag 7's going to come back, I don't know why these people are talking about gold and these other things. You're missing out. You've missed out on a huge rally. Yes, they might come back. You might be right, but what's the point? Is the point to be right, or is the point to make money? Poland's up 30-something%. The S&P 500 is down. Where do you want to be? So continue to rotate, continue position size well. So hopping on to what's next, let's talk about the NASDAQ a little bit. Because, you've mentioned the NASDAQ and you've been talking about NVIDIA and all these things, but let's just talk big picture for a second. NASDAQ to small caps. Once again, I'm not saying like small caps as in, what they should be. Just this is a small cap 600 index. A lot of these stocks are kind of out of the S&P 500 or are small cap names in the United States. So this basically kind of
NASDAQ composite, right? This is not the NASDAQ 100. This is the NASDAQ.
No, this is the 100. This is the 100.
Oh, this is the 100. Okay.
Yeah. So it's the 100. And basically what we're looking at here is in 2000, when this thing topped out and rolled over, which you could see where that red circle is. When this topped out and rolled over, small caps really led the way. Gold miners led the way. Commodities led the way. International stocks led the way. And now we're where we're at today. And it's been many years since that has happened. But these things happen. And the biggest thing I'm trying to say this week is that markets are cyclical. The growth versus value debate, all of these things, like it's not that one is better than the other. It's just markets are cyclical. There will be certain times where value will outperform. There will be certain times where small caps will outperform. There's obviously right now is a time when gold and silver and gold miners have been outperforming. So I think that's something that's very significant. But Kashop, what do you think about the NASDAQ right now? Are people just too crazy about the Mag 7 at the moment? Do you think it's bottoming anytime soon? Or do you think it's a rotation into other areas?
I think it's a long way down back to whatever is close to the fair value. So just look at Apple. Let's say they have $400 billion worth of sales. Now, are they going to be growing their sales at 10% a year? Not likely. Maybe 10% one year, 1% the next. In fact, there's a good chance that they have a degrowth rather than a growth. So now when a stock like this has kind of iffy growth prospects, how do you value it? Well, you value it as a value stock, which is pretty much what value investors do. Except in this case, investors have valued Apple as a growth stock. And why? Because Siri intelligence. Now you look at Microsoft, same thing, Microsoft Copilot. Now you look at NVIDIA, which is the poster child of this entire madness, it's the same thing. And you look at Meta, people are valuing Meta as a multiple of CapEx. So they are valuing it based on how quickly it can spend money, which is insane. And the last time you saw such valuations were during the dot-com bubble. Now, when people start valuing Meta for its cash flows, what would the value be? Maybe 50 to 75% below where it's currently at, especially because a lot of the CapEx expenditure will also get impaired at some point. So that's where the valuation should be. Tesla, all of a sudden, Tesla has been associated with Elon Musk, and somehow he's gone from being the most loud figure to the most hated figure. And every day there's some talk of people keying Tesla cars and doing all sorts of nonsense to Tesla vehicles. I don't know where that's happening, but the stock price is reflecting that. And then you take any of the Mag 7, you take Taiwan Semiconductor. What is Taiwan Semiconductor doing? In order to appease Trump, they want to build a factory here in the United States. Not for the most cutting edge chips they make, but for the lesser ones. So they want to build something here. Now that's CapEx. Now, when you're spending on CapEx, reasonable investors expect a return on that. If you don't get a return on that, then there really is no value to doing that. But right now markets are valuing everything as though the return is something that's going to be blue sky. So once valuations start to correct, it's a self-reinforcing cycle. People come to their senses, start looking at the fundamentals, and then they realize the fundamentals aren't going to live up to the hype. So chat gpt usage of chat gpt peaked sometime last year around March or May, something around then, and it's been a decline ever since. And since DeepSeek came in, subscriptions are getting cut. Now, you will not hear all of this in the news because these are still private companies, but it's starting to matter in the PE world. So there's this company called CoreWeave, which is trying desperately to IPO before this window shuts. There are so many companies that are going public via SPAC and then going straight down. So there was this Bitcoin company, Forge Bitcoin or something. SPAC was at $10. After IPO, the price was $5. So all these deals, what's happening is you're seeing investors are getting antsy because they don't like the valuations. They don't like the fact that all of a sudden the liquidity they depended on, it's not there. So in that situation, when stocks start to correct and you're coming off a pretty high valuation level, so how much lower can you go? Well, there's really no bottom. It's like you can just keep going lower and lower and lower, and there is no end. It's like what we saw with uranium. So uranium had this huge hype cycle, went up from $16. Some of it is hype, some of it is fundamentals, but the blow off top was all pure hype, and it went all the way up to like $120 a pound, and now it's corrected to 70 or 65. Now where is the bottom? No one knows. And if you go back and look at prior uranium cycles, you will see the same thing. The prior cycle took it all the way to $140 and then all the way down to $16. And it was a correction both in terms of price and time. So if you ask me, where is the NASDAQ going to be a month from now? I would guess lower, or maybe, sideways, or maybe even a little bit higher. If you ask me where it is going to be a year or 2 years from now, then I can tell you categorically it's going to be lower, that we are going to have a correction in terms of both price and time. Now, the caveat to that is Jerome Powell wakes up tomorrow and he's like, hey guys, I remember 5 years back, I printed $5 trillion to fight COVID, and I printed it over 40 days. And I'm going to do the same thing again. Now, when you do that, I can guarantee you're not going to be buying the NASDAQ. You're going to be buying copper because copper is going to $20 a pound. You're going to be buying gold because gold goes to $10,000 an ounce. So you're going to be buying all those things, but definitely NASDAQ would be higher in that scenario. But absent a scenario like that, or there's another situation where the NASDAQ would be like, let's kick out all these tech companies, let's add Agnico and Newmont and Hardware Minerals and Rio into our NASDAQ 100 index, and then yes, then you're going to see that outperformance. Otherwise, I would just avoid it because I think it's done for the next 2 years, 3 years. It's done.
Yeah, I don't think there's the outperformance just isn't going to be there. And I think that's what you just have to do as a trader is like the idea has to always be what's outperforming. And once again, I'll update you in a month if the NASDAQ starts to see all the things we're talking about and it looks different. And next thing it starts to move higher and starts to break out and it is the outperformer. Great, but it's lagging everything right now. We just brought that up. That's what we just talked about. I mean, technology and consumer discretionary, which is mainly just Amazon, is down quite a bit. And people are still like, hey, look at this discount here. And it's like, no, you want to buy what's strong. It's the hardest thing to do as a trader. When you first start, you want to buy everything cheap. So you'd look at this chart and you would go, man, look how low the XLY is. I'm going to buy that because it'll catch up to everything else. And really what happens is you want to just find relative strength, and however you diagnose it, that you have to figure that out for yourself. A way to do it is using a 3-month time frame, kind of like this chart, and going, okay, I want to own the leaders in this 3-month time frame, and I don't want to own the laggards in this 3-month time frame. And I think just that, and I'm not talking about just something that's a strategy that I'm talking about out of nowhere. This is a strategy that's been back tested for many, many years. Momentum strategies have been talked about for many, many years. Relative strength begets strength. Most of the time when we see, that's the reason why gold's been leading for a year and nobody wants to buy it, but it's just leading. It doesn't matter how I feel about gold. If I have gold in the safe, if I'm a gold bug, if I bury it in my backyard, it's just leading the way. So as a trader, we should own it. Same with energy right now, in my opinion. It's leading the way. I just think it's worth owning. Now, once again, it's a tough trade. A lot of people have gotten hurt in energy lately, but to me, it's not hurt. It just went sideways. And like Kashab said, people hate sideways. So, you can wait for a new breakout and then the trend might start again. But either way, I think energy will probably catch up considering the way the market looks. Copper is moving. Copper hit a new 52-week high the other day. Gold is up. Silver is up. Silver is the outperformer in the commodities this year. And then I think maybe coffee is above that still. Sorry. But, natural gas, my bad. There's a lot of commodities this year that are moving. My bad.
Sugar's in the top 10.
Sugar's in the top 10. Yeah, but I think silver is above. I think it's 17 or 18% today, year to date. So I mean, silver is moving very nicely, and it all has to do with the dollar. And I brought this chart up a million times. You guys will probably see it a million times again, but it's just on the dollar cycle. And there's, like Kashab said earlier, there are no perfect predictions in markets. I can't say the dollar will bottom perfectly in 2028 because of this chart I just put up right now. I can say that it's a model that I want to continue to pay attention to, because the way the market looks. If international stocks were weak right now, if the copper and gold and silver were weak right now, I wouldn't be, pounding the table on this dollar down cycle. I might even be long the dollar. But at the moment, everything in the market is saying that the dollar is going to continue to weaken. And these other areas are probably going to continue to strengthen. Now, yes, there'll be pullbacks because, the first day we have China down, 5%. Everybody's going to be like, see, it happened. And I'll just remind everybody that, down 5% when the S&P 500 might finally hit flat isn't really anything. But once again, it's all about the down dollar cycle, and this is where these trades are going to continue to move higher, is based on the dollar. If the dollar started to get strong here and it breaks out to the upside, we're going to see a very different market environment going forward. But look at that 100 level. If we can break below that 100 level on the dollar decisively, get even below 99, I would say the dollar's headed a lot lower and probably pretty quickly. And Wavy, you asked about this chart, so I wanted to hit this real fast. Kashab can talk about it after I do. But just kind of looking at this chart, it's gold to the S&P 500. And I've been bringing this chart up a lot lately, and the reason is that a lot of people had a lot of feelings about it. A lot of people didn't like the idea of talking about gold being strong, even though it's really, really high right now. People hate things that are high. When things are up a lot, they go, it has to come down a lot. Gold is just making at the beginning of a run that I think could last maybe another year, maybe a couple of years. I don't know. It'll probably stall out at some point, and then the oil and the other commodities will probably catch up. But I think gold is probably in a nice uptrend for a little while, coming and hitting new 52-week highs, coming out of this Bollinger Band squeeze. And most importantly, it's just where the outperformance is. So it's outperforming the S&P 500. We'll see how long that lasts. But Kashab, getting to back to you on a couple things. We can come back to that later. What do you think about silver and silver miners?
So silver miners, it's really, really difficult to get exposure. I have exposure to one. I might add exposure to another, but again, it's a really, really tough market because it's a very small market. So if you're buying silver miners because you want to get exposure to silver, you're just better off buying silver itself, because when silver moves, it tends to move explosively. So if you're buying silver miners and you know the fundamentals, you know the project, because see, when you're buying the miners, it's not just about the metal, right? So what happens is these are companies, and these companies, other than the producers, they don't make money as such. So what they do is they discover silver, somewhere in Argentina or Bolivia or Mexico, or even Idaho, which is becoming a hub. So they discover silver in all these places, and then they drill more holes into the ground to prove up the deposit. So let's say, a few drill holes, they think there is a million ounces of silver in that, which is not big. Million ounces of gold is probably okay. Million ounces of silver is like pretty much nothing. So what they do is they drill more holes, and they need to finance all this drilling. So they issue equity. So every bit of the way, you're getting diluted on the way to making that discovery bigger. Now the discovery has to get so big that all the dilution is worth it. And it is very similar to, if you invested in Airbnb or Uber when, they were just San Francisco based and, just expanding into California. So they had to dilute. But with technology, they were able to scale, and they became so massive that all the dilution was worth it. Now, unless you hit a monster deposit, all that dilution is not going to be worth it. So unless you are really in the right stocks, and there is no way to know what the right stocks are, because mother nature isn't going to tell you, hey, here's a big load of silver. No one knows that. So you have to place your bets, you have to look at it as venture capital. But if you time it right, and especially if you add technical indicators. So the reason I love relative strength is, so I don't just use relative strength on these ETFs. So I look at relative strength when I look at the miners as well, the exploration stocks, that is the sub $1 billion market cap companies. And when I see price and volume telling me something, I investigate. Maybe someone else who knows that company, that project more intimately, and they are spreading the word in the market through their buying. And when I see that, I tend to have a little comfort knowing that even if these guys are going to dilute to drill more holes, they are going to dilute at a good valuation because other investors like the stock. Now, there'll be some companies which are, kind of in a timeout with investors. Investors don't like them. So when they drill, they need to finance at a discount to market. So all these factors come into play, which is why if you are investing in this space, you're better off going with the professional, or following newsletters, or taking a basket approach. And, self promotion, my newsletter, I have 25% allocation to these explorers. So you have to do something like that, because if you don't understand these dynamics and you just think, okay, silver is going to go up 10%, the silver stock is going to go up 30%, you may not end up being right.
No, I like that because it's all about figuring out how you take advantage of these moves. And I think too many people are just kind of stuck in the idea that you can just, turn around, throw a dart, and hit a mining stock that's going to make money. It's very hard to do. You got to know the space well. Kashop does that just about better than anybody I know. So we'll end on this one. And I think the biggest thing that I continue to kind of harp on is that this catch-up trade is happening. And I don't even like to use the word or terminology catch-up trade, but it's like, look, this is as good as it gets. You got a new fresh new high in silver. You got the situation where gold is all the way at 3,000. I can't see a reason why silver can't make a big run here, and a historic one. Just kind of catching up to that 50. Like once again, like people keep talking about $50 silver like it's crazy. It's like that's not that far away. If you're looking at silver above 30, 35, we're hitting 50 pretty quickly. So I do think that silver is probably the place to be, besides the mining complex and looking at the junior mining space. You make a lot of money right now in all of these. If as a futures trader, you have leverage on silver. We've given out some options trades ideas on silver and silver miners. But man, this is a beautiful setup, and I think it's going to be one of the best trades of the beginning of this year, at some point soon. So, Kashop, do you have anything you want to end on, or we could just kind of end there?
Let's just talk about copper, because copper's hit a milestone as well, above $5. And the funny thing is, this time around, the copper miners haven't participated in the move as much. So last May when copper was on that big run, the copper miners participated. Now it's kind of the market is silent. And I think that's also because you have so many moves happening in the commodity space, investors are spoiled for choice. Now
Mhm.
you go back to 2023 and you looked at US equities. You could buy anything in the S&P top 50 and you made money. And that's just because valuations had corrected so much. And then the Fed had the Silicon Valley Bank bailout and that pumped liquidity into the system and stocks went up. Now, it's a similar situation. You have gold above $3,000, you have copper above $5, you have silver, which is poised to go up to $50 soon. And maybe after that, it kind of takes a breather. So you have these moves across the commodity space. It just feels like investors haven't paid as much attention to copper as all the other metals. I think that will change. So, just like you talked about the catch up trade to silver, I think the next catch up trade after that is copper. So, that's where you want to be positioned in terms of you want to build your watch list. You want to look at your list of companies, set buy stops, whatever it is that you do to get into trends early, and that way when the move happens you're ready. So if you feel you missed the beginning of the bull market in gold, or you missed the beginning of the bull market in silver, don't worry. You can catch the meat of the move in gold and silver, and you can catch the beginning in copper if that makes you feel better.
No, I love that because it's a great thing to end on because I think that's the way the cycle works. I did bring that chart actually, so before we go, I'll bring that up. So I brought this up. I've used this chart a bunch of times, but I've never highlighted the highs for 52-week highs for gold, so people can kind of see what I'm talking about. And so what I mean here is that gold kicks off the commodity cycle. Gold moves, and then a little while later, could be 10 months, 14 months, even the latest. That was the average. The latest was 18 months. After about that period of time, you start to see the other commodities move. So next thing you know, we got copper. Copper is really the first one that usually moves first. So copper starts to move, makes higher lows, starts to move higher. Sometimes copper just bottoms around the same time that gold makes a new 52-week high. And then after that, oil starts to move. We haven't seen that yet at all, but the energy stocks look really good. And once again, it's not their fundamentally they're okay. They're not the best fundamentals I've seen them in, but they don't look that bad. They look a lot better than technology, for so to speak. But these are the value companies we're talking about that people are going to continue to overlook. You have these companies that are producing real things that have pricing power that can survive through inflationary cycles, and so many people are just going to overlook that and go, oh well, I'd rather own Apple today. That's fine. But if you want to outperform, you've got to be flexible and understand where you want to be. I have no problem buying technology. I owned the semiconductors and technology for 2 years. Now I'm looking at these other areas because they're outperforming. And that's where you got to be. You got to be where the outperformance is. And so since 2024, gold's been outperforming. Silver made a new 52-week high shortly after that, and then now again today, it's making a new 52-week high recently. There's only a matter of time before oil starts participating. At the moment, we are not really recommending for a trend model to buy oil, but at some point there will be a good time to buy oil, and I think that'll happen within the next 6 months. So, all right, we can end there. Thank you guys for joining us, Wavy, Breakout. Thanks, guys, for hanging out with us, and we'll talk to you guys soon. We're on every week at 11 a.m. Eastern Time. And if you guys wanted to see the trend following post, I posted it on Twitter. It's also in the description on YouTube. And to chat with us, ask questions, feel free to hit us up on YouTube as much as you can. I know a lot of people watch on Twitter, but we're trying to get more people over to YouTube. Thanks, guys. Take it easy.
Thanks everyone, have a great weekend.